So, Canadian politicians are back to work after their summer break, and they did not waste any time. I've been reflecting on these massive changes that no one saw coming. The changes, well, they're going to impact everyone. Whether you already own a home, or you're looking to buy, or you're just keeping an eye on the market for the future. Some people are definitely going to benefit, but others, not so much. Yep, that's us here in Atlantic Canada. Either way, these changes could directly affect your finances. Let's get into it. One of the most significant changes announced is the increase to the maximum purchase price for insured mortgages. While that might sound a little bit technical, it has a huge implication for buyers in Canada, and it's the most expensive markets, like Southern Ontario. Previously, the cap for an insured mortgage was set at $1 million, meaning that if you wanted to buy a house that cost more than that, you needed to put down at least 20% to avoid paying mortgage insurance. Now, that cap has been raised to $1.5 million. And this is allowing buyers to access insured mortgages for more expensive homes with a smaller down payment. This is simply wild, and I'm having a hard time with this. I know home prices here in Atlantic Canada aren't that, and first time home buyers certainly are not in that price bracket. But let's break this down and what it really means. In Canada, there are two types of mortgages. There is uninsured and there is insured. If you're buying a house and you can put at least 20% down, you've got an uninsured mortgage. There is no mortgage insurance needed. And this is ideal because you're not paying any extra premiums monthly. So, for example, on a $1 million home, if you have $200,000 for a down payment, that's 20%. You don't need mortgage insurance and you're good to go. But if you don't have that 20% down payment, that's when things get a little bit trickier. Let's say you only have 10% for a down payment. The bank would consider you a riskier borrower because you have less equity in the home. So, to offset the risk, the bank will require that you get mortgage insurance. And this is to protect them in case that you default on the loan. This insurance is paid for by you, the buyer, and it can increase your monthly costs. Now, historically, there was a limit to how expensive a home could be if you wanted to qualify for an insured mortgage, and that cap was $1 million. This meant that if you were trying to buy a home in a high-priced area like Toronto or maybe Vancouver, where oftentimes homes exceed $1 million, you either had to come up with 20% down or you're out of luck. But now that's changed. Thank you, Government of Canada. The government has raised this cap to 1.5 million. And this is a big deal because it means that buyers who previously couldn't get into the market with the lower down payment might actually be able to qualify if that home costs up to 1.5 with as little as 5 to 10% down. Trust me, I already looked and it does not apply to rental properties. On the surface, this seems like a win for buyers, especially the first-time home buyers who might have struggled to save for a down payment. But there's more to it than meets the eye. One of the key benefits of this change is that it could make it easier for people to buy homes in high-cost markets. As I mentioned, Toronto and Vancouver, those two always come up in the news. And these are where home prices have absolutely skyrocketed. This new rule could allow buyers to get into the market with little cash up front. But there's a catch. By making it easier to borrow money, the government is also encouraging people to take on larger mortgages. And that comes with its own set of risks. The first risk is that it could fuel even higher home prices. I know. By raising the cap for insured mortgages, the government is effectively increasing the pool of potential buyers who can afford more expensive homes. This increase in demand could push prices even higher in already overheated markets. While this change might actually help people get into the market now, it could lead to a vicious cycle of rising prices, making it even harder for future buyers to afford a home. Another factor to consider is the length of time over which people will be paying back these larger mortgages. One of the changes that has gone hand in hand with this new policy is to extend the amortization. In simple terms, amortization refers to the length of time you have to pay off your mortgage. Typically in Canada, mortgages are amortized over 25 years, but now many people are opting for 30-year mortgages. A 30-year amortization can seem attractive because it lowers your monthly payments. After all, if you're paying off your mortgage over a longer period, each individual payment will actually be smaller. However, the trade off is that you end up paying more interest over the life of the loan. And this means that your monthly payments might actually feel more affordable. You're actually spending more money in the long run. So, who really wins? So, is this a good move? Well, it actually depends on how you look at it. On one hand, these changes make it easier for buyers, particularly first time buyers, to enter the market. On the other hand, they also encourage people to take on more debt over a longer period of time, which could have long term consequences for their financial well being. There's also the deeper question of whether these policies are actually addressing the core issue of housing affordability. The government claims that these changes are actually meant to promote generational fairness, and it's helping younger Canadians affording homes in markets that are increasingly out of reach. But are we really solving the problem, or are we just kicking the can down the road? Well, most would say yes. If we look at the bigger picture, the real issue isn't just about making it easier to borrow more money, it's about the higher pricing of homes themselves. Instead of bringing prices down, these policies might actually bring it up. So, making it easier for people to take on more debt, the government is essentially admitting that high home prices are here to stay. Now, I can hear the keyboard warriors down below. So, while this may help some buyers now, it could lead to more debt and financial instability down the road. Speaking of risks, there's another element to consider. Who's really on the hook if things do go wrong? Mortgage insurance is actually backed by the federal government, meaning that if a large number of people default on their mortgages, it's ultimately government. And by that, I mean us, the taxpayers. This could pose a significant risk to the broader economy if housing prices fall and defaults rise. So, what does this all mean for you? If you're a first time buyer, these changes might help you get into the market with a smaller down payment, but you need to be aware of the risk: larger mortgages, longer repayment periods, and the possibility of rising home prices. If you're already a homeowner, these changes could actually boost the value of your property, but they could also make it harder for future buyers to afford the home. From where I sit, this does feel like a short term solution to a very long term problem. The government is making it easier for people to buy homes today, but we still haven't addressed the underlying issue of affordability. Are we just creating more debt for future generations? Only time will tell. What do you think? Is this the right move for the Canadian housing market, or are we just setting ourselves up for problems down the road? Let me know in the comments down below, and if you found this video helpful, don't forget to subscribe. Thanks for watching, and until next time.